Good morning from our global headquarters in New York. I'm Manus Craney. You're welcome to Bloomberg Brief. Let's set that agenda. Revisions in focus. Investors brace for the latest jobs report, as Laurie Logan suggests rates may already be close to neutral. Can't keep up. Amazon joins big tech in warning capacity constraints endure in their voyage to meet AI demand. And Treasury Secretary Scott Bessent attempts to calm markets with his stance on a strong dollar policy and the debt plans. Good morning to you. It's Jobs Day. The whisper number on the Bloomberg terminal, 196,000. Consensus, 175. Flat on the NASDAQ. We'll talk more about the individual movers there in a moment. We're almost priced to perfection is the narrative from Goldman Sachs and Bank of America have got the flow show out. $600 million left U.S. equities in the week to the 5th of February. So we're counting down to the jobs number. Cash and bonds, they attracted the bulk of the inflows. And I want to take you to the bond market. This is important. 443. You're down 10 basis points on the week. The bond market has been falling in yield for 4 weeks in a row. You have not seen that since 2021. And 10-year bonds closed below the Fed funds for the first time this year. As Scott Bessent gave a very clear message on day 2 in his outing. We are here to control the yield curve. And the path to that is via energy and the Doge Committee, on which he says we are very aligned, Elon Musk and himself. Alignment. We're also keeping an eye on a couple of other stocks for you. Pinterest surging. They posted strong holiday quarter revenue and gave an upbeat forecast on the sales for the current period. Expedia also soaring after the online travel agency posted better than expected gross bookings during the winter and reinstated the quarterly dividend. Porsche dropping to a record low after the sports car maker said it'll take a hit of more than $800 million linked to revamping its lineup this year. Brutal. In just a few moments, Max Kettner joins me from HSBC. Later in the hour, Citi's Veronica sets the non-farm payroll table, and an exclusive interview with the ECB Governing Council member Boris Vujicic. That's a little bit later in this show. Max Kettner joins me. He is the Chief Multi-Asset Strategist over at HSBC. Max, good to have you with us on Jobs Day. You last put out your big note. It was pretty big headline. Goldilocks on steroids. We've had a number of disruptive moments, from the revelations of DeepSeek to the tariff narrative. Does that uber bullish stance challenged in any way, or do you remain 100% convicted to it?
No, it's 110%. I think, if anything, when we look at the last 2 weeks, it's incredible what's been thrown at the market in the last 2 weeks. We started with the AI trade is over, and it was all about some of the Magnificent Seven disappointing overnight. We've got Amazon as well. We had, we had Alphabet, we had Microsoft allegedly with really negative surprises. We obviously had the concerns around tariffs. Now, all of that in the last 2 weeks. And what happens? The S&P is flat. Right? It's flat. It's genuinely just flat. Nothing's happened. High yield spreads have tightened. Emerging market debt spreads have tightened. Investment grade spreads are flat. So frankly, for the amount of really bad things, of bad stuff that's been thrown at the market in the last 10 trading sessions or last 9 trading sessions, it's been incredible. It's actually, if that is the worst reaction, then bring it on. I'll take it every day. In reality, you've just mentioned it. We've just seen funds. We've just seen money leaving U.S. equities. We've seen, when we look at some of the sentiment surveys, the AAII bull-bear spread is a net bearish again. And again, despite prices not having changed. How can I be, how can it be bearish at all? How can I not look at that and be like, it's as Goldilocks as it can get?
So if you want to bring it on, then, is part of the thesis, when I was running through the markets, bonds, down for 10 basis points this week, down for 4 weeks in a row. We haven't seen that since 2021. This is something very strange given the tariff narrative versus this shift lower in the 10s. Does that add to your 110% bullishness? Bring it on.
Well, now it makes it 120, Manus.
I guess, we're going up. It's a fast market in your bullishness, Max. Good morning.
So I guess, when we look at it when we look at all the things that have been thrown at the market in the last 2 weeks, I think actually people have been focusing on the wrong thing. The main thing that's really changed over the last 2 weeks compared to the concerns in Q4 was around fiscal, was around the yield curve, was around issuance at the long end. For all the talk around tariff, around what the new US president is going to do, what's happening with DeepSeek and AI, actually, I would argue the last 2 weeks, the main thing that's happened was Scott Bessent with the quarterly refunding announcement. You know, remember in November he was saying, oh, you know what, I really don't like what Janet Yellen's been doing. She's been overpaying by issuing at the front end, and we should be extending maturities much, much more. We should be issuing much more in the long end. And the reality now is he's been telling us, and the Treasury has been telling us, actually for at least the next several quarters, the issuance pattern is going to remain the same. And that is super bullish. It's bullish for the long end. It's bullish for long end yields. It should mean flatter curves. It should actually, particularly given that we think in the next 4 months, underlying inflation, super core inflation in the US can come down really quite significantly in the next 4 months, the January to April period. That should help as well. And as the long end comes down, that helps everything. It helps even emerging market asset classes, from equities to rates and to credit.
So this drop in the yield, as you say, underpinned by Scott Bessent, do you become even more bullish then when you hear about this channeling of alignment on energy and the Doge committee that he made not the Doge committee, but the head of Doge, which is Elon Musk? That's even more convincing, isn't it?
Yeah, I would, however, say it's mostly to do with oil. So we, in our tactical asset allocation view, we are really significantly underweight in oil and overweight in gold. But we've been underweight in oil now for the last 3 weeks after that spike that we had at the end of last year and the beginning of this year, simply because, you know, that front-end driven spike in oil that was driven by cold weather, you guys know it in New York, by cold weather, by this squeeze in inventories and the latest sanctions by the old US administration. All of that should really prove temporary, and we're seeing that already. So oil down back to 70, maybe even temporarily below 70. All of that actually adds to the Goldilocks narrative. It adds to the narrative that inflation expectations, particularly at the front end right now, are too high. But even at the long end, when we look at the divergence that we've seen between inflation expectations, break-evens, and oil prices, that can come down as now those concerns around more issuance at the long end are really, really reduced. And then that means term premium, that increase in the term premium we've seen since September, is really a bit overdone. And all of that really, really helps that Goldilocks narrative.
OK, so Goldilocks endures. You want to be long risk. At any margin, is there a risk to growth because of this narrative around boomerang or retaliatory tariffs as and when we go through this tariff phase? That is a real risk, Max, that everybody else in the market is talking about. How prescient is that for you?
I think, however, Manus, when we think about it over the last 2.5 years, that's been genuinely the big risk over the last 2.5 years. Since Q3 2023, really, or 2022, sorry, so for the last 10 quarters, really, consensus has been constantly talking about these long and variable lags, which, frankly, I still don't understand what they mean. It's kind of like, well, you know, so far we've been wrong, but give us time, and at some point growth is going to go down. What that does is it keeps consensus expectations, growth expectations, relatively low. Now, that's changed now. That's changed for the first time in 2.5 years, where consensus expectations, when you guys look at the Bloomberg terminal, at these Bloomberg consensus expectations, they're 2% plus for the next few quarters. So I am with you that at some point, maybe this year, those higher growth expectations now, they could be started to be disappointed. But why not yet? Why is that not a story for the next, call it 5 months, not for H1? Because as we see data only coming in line, not surprising so much to the upside again, and maybe even a tad surprising to the downside, that takes out that tail risk of a rate hike, you know, maybe even this year or H1 2026. And as we take out more and more of that tail risk, again, that adds to the Goldilocks narrative. So it is one, I would say it's maybe one for H2 25. It's not one for the next 6 months.
The other big story that we've got is obviously from the DeepSeek story, and that is this renewed bullishness on China tech. I mean, you look at the Hang Seng, it is flying higher. Does this play into your, let's say, go beyond US exceptionalism and look for opportunities? To what extent can China actually deliver in the face of tariffs? Because if they do more stimulus, that is a bullish story. Tech is lit up because of DeepSeek.
Yeah, I think China is still a buy here on the equity side. I think emerging market equities are a buy. It's not just the tariff and not just the DeepSeek story, but of course China internet looks really, really attractive if indeed the AI story is broadening out from purely CapEx, so from purely AI spending, to broadening out to the AI enablers, so to those companies that actually have to spend the CapEx, and that so far, particularly last year, we've had sort of those concerns in the market around, oh, you know what, can they really make money of it? There was all these constant concerns around monetization. Those guys should actually then benefit. So I would say 100% with you, it's going to broaden out a bit away from purely AI infrastructure, purely AI CapEx beneficiaries, to more the AI enablers. And that's good. But let's not forget, what we heard from most of the Mag 7 over the last 2 weeks has been nothing at all around, oh yeah, we're going to dramatically cut spending. No. So even that story is still very much alive.
No, we're very much up there in over 250 billion for the year. Your enthusiasm, your bullishness is infectious. Max, thank you very much. On Jobs Day, Max Kettner there from HSBC. Other stories trending on your Bloomberg terminal. This is what we got for you. Shares of Nissan climbing as Foxconn reportedly making another pass at the car maker as its tie-up with Honda falls apart. Now, it backed off in December after the deal was penned to bring both brands under a single holding company. Honda and Nissan confirmed this week that they're still discussing various options, including the possibility of ending negotiations. BYD shares are on track for their best week since 2020. Investors await the autopilot update. It will showcase progress on the system and introduce more intelligence features at its low-priced cars at an event scheduled on Monday. Now, any significant breakthrough in its technologies will intensify the competition in China's EV market. Now, a plane carrying 10 people went missing in rural Alaska on Thursday during bad weather. According to Alaska's Department of Public Safety, the Bering Air flight was headed to Nome with 9 passengers and a pilot on board. The Associated Press reported that rescue crews are scouring the ground for any signs of the wreckage of the jet. Bloomberg Brief, I'm Menace Craney in New York. Amazon shares falling in the pre-market trade after weaker than expected outlook. The e-commerce giant was warning investors it could face capacity constraints in its cloud computing division. That's despite the plans to invest more than $100 billion in AI this year. Matt Bloxham is with me to go through this. Matt, you look at Andy Jassy, the CEO, saying it's going to be a lumpy year. You walk away from this week and all of them, Amazon, Microsoft and Alphabet, all talking about constraint. What is Amazon's constraint in the cloud?
How much data center capacity they've got, which is the same as everybody else, and the constraints about how quickly they can bring that on, or how quickly they can get hands on NVIDIA chips, how quickly they can manufacture their own chips, and how quickly they can get power supply into the data center capacity that they have. And so that's what this $100 billion CapEx is there to try and help them fix this year. I think there's not too much they can do in the short term about the chip supply chain, but they can certainly spend money to build more physical data centers and get power delivered to them. So I think they indicated on the call yesterday that they hope that the second half the capacity issues will kind of ease, and that the lumpiness might start to smooth out a bit from there.
So this is about the monetization. This is about the belief in the monetization and the usage. I was looking at Deutsche Bank this morning. Great line from Mr. Reid over at Deutsche Bank. It's like the telcos in 1999-2000 with 3G licenses, but without the debt. So long as the demand carries through, and that is the big caveat, isn't it? It's the monetization of that demand.
Yeah, it is, and Andy Jassy very optimistic about the outlook for AI, and essentially saying every single compute process and application in the future is going to have to be reimagined with AI at the centre of it. So that's kind of what's really fueling their investments. As you say, there are some similarities to the 3G. Back then I can remember doing all sorts of models on how valuable those 3G licenses were or weren't, and it is about the applications in the future and how much people are going to pay for these things. And that is still very much a big question mark. I think the difference here is, that there is clearly, even without AI, a huge amount of cloud demand, and you can you can bring this data center capex through in a quite modular way. So if demand starts to wane, they probably can slow down that capex investment. Perhaps not this year, but in years to come. And these data centers, will last 30, 40 years. That there is some management of the risk here, I think.
Well, those hyperscalers are going to spend $280 billion this year on capex. Let's talk about Apple. Constantly lambasted for not having freshened up their lineup, but it looks like they're going to go for the lower end, a new model in the lower end, and this is about defending market share and indeed perhaps maybe even winning some back.
That's right, yeah. So a refresh, I think, of the kind of the low end and possibly even a thinner model coming later in the year. So I think that's really important for them, given, I think the iPhone 16 demand's been a bit lackluster. I think it also potentially helps them in some of the emerging markets, like, for example, India, where you do need a lower price point. I think the Apple brand has huge global appeal, but the price point out of reach for lots of people. So a cheaper phone, not just lower segments in developed markets, but some of these emerging markets where there's huge potential, could help them to build their market share position.
Matt, thank you very much. Let's see when that new shape and style comes to the market. Matt Bloxham there. Coming up, Secretary Bessent strikes a cautious tone. More in the conversation on Bloomberg. That's next.
First of all, the strong dollar policy is completely intact with President Trump, and I was very happy at his Economic Club of New York speech in August when he re-emphasized the importance of maintaining the dollar reserve currency status. What we are focused on is lowering rates. So we are less focused on the specific of rate cuts and how do we get the whole curve down. I mentioned that the 10-year, I believe, is the important price to focus on. It's mortgages, it's long-term capital formation.
U.S. Treasury Secretary Scott Bessent speaking to Bloomberg yesterday. Let's unpack what we learned from that interview. Joshua Galoo is with me. Josh, the sense here was a message of control of systems, a control of the bond market, and very much alignment with the external, which is Elon Musk and Doge.
That's right. He clearly had a message that was meant to calm any of the tumult that has come out of the administration so far, specifically around the Elon Musk and his Department of Government Efficiency. There have been reports, obviously, that they're going through, that his workers are going through Treasury payment systems and looking for inefficiencies and waste. And Bessent wanted to clarify that they do not have control of the payment systems. They cannot unilaterally stop payments. All of that runs through the systems, run through the Fed. I think that had a calming effect, although it probably does little to calm the politics of the situation, where many Democrats, probably the entire party, and also quite a few Republicans are concerned about privacy, about the amount of power that Musk has amassed in the administration, and a unit that he is in charge of that isn't clear in terms of what the accountability for that is. So Bessent, though, he struck a tone not only of trying to calm some concerns around that group, but also took a stab at another thing that's very dear to Trump. In his first administration, he spent a lot of time lambasting the Fed for keeping interest rates too high and also for not tamping out inflation at the beginning of the pandemic. But he said that this administration, and he certainly will not be commenting on monetary policy. He's going to stay out of it. He thinks Jerome Powell, whom he met with recently, is going to make the right decisions. And Bessent and the administration are more concerned about longer-term rates, the 10-year Treasury, specifically that is more tied to mortgages, long-term capital formation, things that Trump will certainly need to get right, given some of his other policies like tax breaks.
And he certainly went on to say about Doge, which is this is not a roving band running around. These are trained professionals. So I think he really sort of trying to reassure on that. We understand the president, Donald Trump, had a meeting with the Republican lawmakers. Now, this is about upping what he's going to put into the tax deal, but how he's going to pay for it. And time immemorial has talked about, pulling carried interest. But what is really on the table to help pay for the SALT tax deduction being raised?
Well, like you said, ending the carried interest break. I mean, that's certainly one thing that is going to get the most attention in terms of on the Hill, where the fights are going to happen, because this, as you mentioned, this has come up forever as a potential way to save, and it gets fought. Any changes to that face fierce resistance from private equity managers, venture capital, in terms of how that money is taxed. So, it remains to be seen whether they can strike a deal on that. But in terms of other payments, he wants to also end taxes on tips, Social Security, that sort of thing. These are going to be things that speak to certain parts of his base politically, and in order to get this passed, he is going to, at least Speaker Johnson is talking about wrapping this together with an immigration bill, which is going to make it harder for dissenting Republicans to defect.
Of course, the one big beautiful bill. Josh, thank you very much. The debate in Washington. Joshua Galou there on the very latest. We are counting down to your jobs report. Citi's Veronica Clark is joining me next around the desk, right here on Bloomberg. From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Menace Crenny. Let's set your agenda. Revisions in focus. Investors brace for the latest jobs report as Laurie Logan suggests rates may already be close to neutral. Can't keep up. Amazon joins big tech in warning capacity constraints to meet AI demand. And don't miss our exclusive interview with the ECB Governing Council member, Boris Vujicic. That's coming up. Markets, it's jobs day. Whisper number at the moment is 197,000. It's gone up by another 1,000 since 5 a.m. Stocks are flat at the moment. We'll talk about the tech stocks in just a moment. 61.06. Prepare for a 1% swing. We just had Max Kettner from HSBC. He is unequivocally 110% bullish. And for him, it really is about the flow of money. By the way, $600 million left equities last week on the Bank of America flow show. Roll it over. Have a look at the bond market. This is where it gets crunchy. Bonds trade at 443. It's the first time that 10-year government bonds are below the Fed funds in 2025. We're down 10 basis points on the week. We're down for 4 weeks in a row on 10-year government bond yields. You haven't seen that since 2021. Scott Bessent, it really does confirm about the long end and no change in issuance. That is driving this narrative, along with the desire to control the longer end of the curve, to control the whole curve, to be pretty precise. Those are your bond markets. Let's see how they react on the back of the jobs number. As I say, the consensus number estimate is 175,000 of an ad for January. Keeping a close eye on those yearly revisions. Veronica Clark is with me around the desk here this morning. Veronica, good to see you.
Yeah, good morning.
You're going for, it's the first time in a long time, actually. You and the whisper number, you're moving into natural alignment. But stability would be the byword for you.
Yeah, I mean, we definitely have seen this surprising stability in the labor market, at least surprising to us in the last 6 months or so. We were definitely, understood the weakening that we saw over the summer and expected that to continue. And it does seem like there's some more stability. And yeah, we're expecting 195,000 jobs today. I would still say, though, that there is a lot that makes us uncomfortable about that stability. In a lot of ways, this doesn't necessarily look like a healthy labor market. We still see the hiring rate very low. But there are well-known seasonal adjustment issues with this January number. Maybe we don't see that weakness until the spring.
You've been saying this consistently month after month.
Yeah.
And yet this data has yet to, somebody's out of sync. The data has yet to catch up with you, or you've yet to catch up with a shifting narrative?
Yeah, I mean, certainly if the data are proving us wrong, we want to admit that. But I haven't seen anything change in the fundamentals of how businesses and how consumers are viewing the labor market. We still see essentially it's a very low churn labor market. We don't see the big layoffs, but we also see the hiring rate very low. We also see quit rates very low. People don't feel good about the labor market. Businesses aren't hiring. And I wonder if there are these seasonal issues where it's really in the spring and summer when you would expect businesses to be hiring. And that's the time of year, the last couple years, that we've seen that unemployment rate rising. So I do worry that as we get to the spring and hiring is still low, we'll see that weakness again.
The DOGE is active, and the offer is out there to federal employees to sign up for early retirement. We understand the number is 50,000. What kind of number shifts the dial at that in that narrative for the unemployment report?
Yeah, there are a lot of uncertainties surrounding federal employment right now. Questions on the timing of when we would see that in the data. Maybe we really don't see it until later in the year. But I think if you were getting to 100,000, 200,000, yeah, you would certainly see that in the data. And I don't necessarily believe that this is a healthy labor market that people will be quickly finding jobs in. We see that in if you do get laid off, it's taking you longer to find work.
So is my bargaining power for wages lower?
Yeah, and I think we've seen that.
And is that coming through in the data? The ECI has slipped.
Yeah, exactly. I think we have seen wage growth slowing. The Atlanta Fed does a helpful breakdown of wages by different types of workers, and you definitely see wages for people who are switching jobs that have come down a lot. There is still some stickiness if you stayed in your job. Maybe your wage is catching up to a higher market wage over the last couple of years, but it does seem like demand for new workers, those workers are not getting the big wage bumps anymore.
So do we drift in this 4 to 4.3? What is it that breaks us out of that cycle that then has got a consequence for the Fed?
Yeah. I really worry as we get to the spring, and if hiring is still very low, maybe we get an animal spirits optimism induced increase in hiring. Although on the other hand, maybe tariffs and policy uncertainty has businesses pulling back a bit more. I would worry as we get to the spring, we could see numbers like 4.4%, 4.5%, and that on the unemployment rate, the Fed would get much more concerned, I think.
We are debating when tariffs actually go live. They still haven't gone live yet. Technically, there's still a couple of days for China. Are you a believer in a material growth shock?
Yeah, I don't think so.
To the U.S., I should say, in the first instance.
Yeah, I don't think so. I think we probably will see is eventually when we get some kind of, details on a reconciliation bill, maybe we do see corporate taxes, cut a bit more to help offset that. And so far, a 10% tariff, that's not nothing, but I think that's manageable. Certainly, if we were to get 25% on Canada and Mexico, we'll come back to that in March. That, I think, would be a much more material growth shock.
And this is what the Fed has got to grapple with, isn't it? So let's just listen to what Laurie Logan had to say yesterday.
Mm-hmm.
On-target inflation, alongside 2 quarters of stability in the labor market and demand, would strongly suggest that we're already pretty close to the neutral rate, without much near-term room for further cuts.
That's an interesting shout from Laurie Logan. We're almost pretty much at neutral. Even if we come back to 2%, it's not really justifiable to cut. Where do you stand on the restrictive to neutral argument?
Yeah, I think she's certainly on the more hawkish end of things. I would think that this level of rates is restrictive. And we see that in very low hiring, gradual loosening in the labor market at least. The rate-sensitive sectors, housing, manufacturing, those still seem relatively soft. We've seen some stronger manufacturing data recently, but maybe that doesn't last. So I do think that this is still a restrictive level of rates.
The compilation of headwinds to this economy are coming. You've got tariffs, you've got restructuring via DOGE, you've got a number of fronts there. Where do you sit? We've had Adam Posen and State Street this week talk about stagflation. How real a risk is that for you?
Yeah, if we are getting into, policies like substantial immigration changes, maybe tariffs would be part of that. There is a risk that policies would mean softer growth and higher inflation. But maybe because that's what they would entail. We don't think that we'll be getting those big disruptive kind of policies. We're not expecting mass deportations, for example. We're not expecting the big disruptive 25% tariffs on Canada and Mexico. So I don't think that is a high risk right now, at least.
Look, the other big unknown is the revision to last year's numbers. I think in August time we thought it was going to drop by 818,000. That's been drifting downward. Are you in the downward drift camp to the revision?
Yeah, we never really know, and how do we know?
And there's no press conference today to discuss it.
There isn't. We never really get a whole lot necessarily from the BLS, and how do we know a whisper of revisions? I think it's probably likely that we'll still see some pretty big downward revisions, maybe something like 700K.
And if it's more than that, then that's a material number to you.
Yeah, I mean 700K is already a pretty material number. Those would be some of the largest downward revisions since 2009. I think it is just reflecting that there are a lot of measurement issues with a lot of this data post-pandemic, which is why, to form your view on what's happening, you have to look at many different data sets over many different months, and that's where there does seem to be a lot of weakness in this labor market.
Well, Veronica, you're in alignment. 197 on the Whisper, and you're at 195. So thank you very much for joining us, setting the tone there. Veronica Clark of Citi. On Jobs Day, and there are other stories trending on your Bloomberg terminal this Friday morning. Amazon in the news. They're warning investors that the cloud computing division could face capacity constraints despite the plans to invest $100 billion this year. CEO Andy Jassy says growth will be lumpy due to delays in getting hardware and insufficient electricity. This echoes similar concern from Microsoft, which had concerns about keeping up with AI demand. And China's growing influence in AI has sparked optimism towards the nation's tech shares, with Hang Seng Tech Index entering a bull market. And DeepSeek's model has been hailed as a game changer, prompting the broader reevaluation of big tech companies. Wall Street brokers are upbeat, arguing that the Chinese discount will vanish. And shares of Nissan climbing as Foxconn reportedly is making another pass at the car maker as its tie-up with Honda falls apart. It backed off in December after a deal was penned to bring both brands under a single holding company. Honda and Nissan confirmed this week that they're still discussing various options, including the possibility of ending negotiations. It's Bloomberg Brief. I'm Manasquani in New York. In just 2 weeks, the Treasury Secretary, Chief Scott Bessent, has seen plenty of turbulence. The department became the target of Elon Musk's crackdown on federal spending, triggering protests outside Bessent's office. Investors have been on edge since President Trump has dangled the implementing of tariffs. Yet, in an interview with Bloomberg TV yesterday, Bessent sought to telegraph a sense of normalcy. Let's just unpack that a little bit. What do we learn from the interview? Kevin Whitelaw is with us. Kevin, good morning. Good to see you. So here we are. I would say this, if you listen to that interview, the messages were very clear from him. It was about control and systems control, and it was about trying to quell the anxiousness of the bond market and really reassure the dollar hegemony.
Well, Scott Bessent was chosen in part after what had been a longer deliberation than for many of Trump's other cabinet picks, was chosen to be a reassuring signal to markets. And, as someone, a market professional who's going to come in and sort of keep things on track for what Wall Street was looking for. And so a lot of this interview was about a sort of projecting a business as usual kind of moment, talking about, not meddling in, sort of the Fed's business and maintaining a strong dollar policy and other reassuring messages. But obviously at the same moment, you do have Elon Musk and his team of Doge, engineers running around and accessing the system that pays America's bills with very little transparency or really any clear sort of official mandate or record keeping. And so I do think that as much as there was that surface message, it really sort of is a little hard to take at face value when obviously there's this enormous level of disruption going on underneath the surface.
And then, of course, he talked about the alignment between himself and Elon Musk and on those people in Doge, highly trained professionals. That is not some roving band running around doing things. As you say, it's about reassurance. Let's flip over. There was an offer to take early retirement to a lot of federal employees. We understand that number's at 50,000. That's not what they'd hoped for, and now they're pivoting to perhaps a slightly more aggressive policy here, aren't they, in terms of looking at people's review sheets, their yearly review sheets?
Yeah, I mean, I think this the numbers on the buyout, which I believe a court has also hit pause on for a little bit, does show that there's maybe a lack of trust on the part of federal workers about what this offer is and how real and how firm and clear the terms are. A lot of federal unions warned their workers against taking it up, and so that was the carrot, and Trump also has the stick, and there is talk about layoffs. There's talk about tougher performance reviews, and you're also watching what's happening at USAID, where a whole agency is facing the threat of layoffs, and that's only sort of the first. We're only 2 weeks into the administration, and so he's not done. He's going to pursue a lot of different avenues, but you're also, I would expect, going to see a lot of court challenges from individual workers, from unions, and others who are going to say that Trump doesn't have the authority to do this.
Look, we're trying to understand whether we're going to have one big, beautiful bill or not, but the tax bill is rising. There's lots of promises. President Trump met with the Republican lawmakers to talk about these tax priorities. He wants that SALT cap raised, but to do that, he's got to look at some pretty old principles. Private equity world are a bit worried now. Carried interest is back on the chopping block, as it always is. What else is on the agenda to pay for the tax cuts?
Well, I do think, he is targeting some of these favorite, slightly more populist themes, even as he's basically also still trying to do a tax cut that's going to benefit the rich. So it is a weird mix of populism and not populism, I guess, if you'd call it. But Trump does face that deeper problem of he really wants to cut spending as much as he can, but he really wants to cut taxes even more. And so how do you do that without ballooning the deficit? And I do think this SALT tax is an obvious target. He talked about it a lot in the first administration. It's coming back, and it is something that if he targets it right, it conveniently tends to hit Democratic-run states a lot more painfully than it does Republican ones. So it does kind of fit in with that broader message of us versus them.
Well, look, the Senate and the House have already split this week in terms of their intentions or their indicated intentions in terms of bills. The Senate obviously wants to go for something a little bit skinnier and have a victory sooner. This split, how does it get healed between the Senate and the House?
It's going to take a long time to sort out exactly where they can head with this, but at some point it's going to come down to votes, and the House has the thinner margin. The House has a very, very, very thin margin of control for the Republicans. They cannot afford to lose many votes, which means that there is a bit of a lowest common denominator problem that they don't have in the Senate. Senate, on the other hand, does have still a couple of traditionalists who have very strong feelings about certain, spending programs and certain levels. And, we haven't seen a lot of fight from the Republican Senate yet in terms of Trump's agenda. But at some point, when it comes down to money, when it comes down to things that are going to hit districts hard, hit states hard, politics is going to come back into this very, very significantly.
Kevin, thank you very much. Kevin Whitelaw there with the very latest on the political machinations in Washington. The bond market is ground zero. We're here for Jobs Day. The consensus whisper number is 197,000. But what I want to show you is really the past 5 days in the bond market, which has been pretty prescient. Down 10 basis points. We've been falling for 4 weeks in a row now in this bond market, and you have not seen that since 2021. A very clear message yesterday from the Treasury Secretary. We want control. We're aiming to control the curve. There's your performance in 10-year government bonds this week. And again, this adds to the narrative for HSBC, Max Kettner, which is about emboldening his view on taking risk. BMO says we're listlessly shuffling towards this jobs report as Laurie Logan says she's skeptical, really, about already at the neutral rate. And even if we get to 2%, doesn't necessarily mean a cut. As you can see there, the slope down in those bonds on yield for 4 weeks in a row. It's Bloomberg Brief. I'm Manus Cranny in New York. A look at the rest of your day. Guess what? It is the January payrolls, 8:30 a.m. Eastern. We will bring you that live and analysis in Bloomberg Surveillance, followed by the University of Michigan consumer sentiment data at 10 a.m. and those inflation numbers in there as well. Fed speak, plenty of it. Governor Bowman at 9:25 and Governor Kugler at 12 noon. There's some stocks to keep an eye on as well. We have Tesla. China's January total shipments dropped by 11.5%, and that's based on the preliminary data released by China's Passenger Car Association. Amazon continues to dip as the currency headwinds weigh on the outlook. It also gave a warning that it can't keep up with the AI demand. And Expedia extends post-earnings gains on robust results, reinstated its quarterly dividend. But it comes down to controlling the market. Scott Bessent has had a bumpy first 2 weeks. The Treasury chief has had to deal with the controversial crackdown on the federal spending, the threat and reality of President Trump's tariffs. Yet in an interview with Bloomberg TV yesterday, Bessent sought to calm the markets and assure stability.
These are Treasury employees. It is 2 Treasury employees, one of whom I personally interviewed in his final round. There is no tinkering with the system. They are on read-only. They are looking. They can make no changes. It is an operational program to suggest improvement. So we make 1.3 billion payments a year. And this is 2 employees who are working with a group of long-standing employees.
The letter that the Treasury Department sent earlier this week talked about how the team currently does not have access to change the system. Have they at any point this year had the ability to make changes?
Absolutely not. This is no different than you would have at a private company. And by the way, the ability to change the system sits over at the Federal Reserve. So it doesn't even lie in this building. So they could make suggestions on how to change the system, but we don't even run the system.
And if they ask for, if they request the ability to change the system, would you grant that?
No, again, they have no ability to change the system. I have no ability to grant that change. That they could make suggestions, then it would go to the Federal Reserve, and just like any large ERP system, there would be tests, there would be this, there would be that, and then the Fed will determine whether these changes are robust or not.
As the Secretary of Treasury, you also oversee the IRS. Do you know what kind of access the team has to IRS data or individual taxpayer data?
Well, I'm glad you asked that too, because look, the IRS, the privacy issue is one of the biggest issues. And over the past 4 years, we've seen a lot of leaks out of there. The IRS systems are quite poor. When I started in college in 1980, I learned the program in COBOL. I think there are 12 different systems at the IRS that still run on COBOL, but as of now, there is no engagement at the IRS.
And if they request that access, would you sign off on that request?
They haven't, so we'll take that when it comes to it. I think there is a lot to do there, but the president was elected with a big agenda, and to the extent that getting the IRS in better shape is part of that, sure. Because look, with the IRS, what am I concerned about? I am concerned about collections, I'm concerned about privacy, and I'm concerned that the system is robust.
That was the Treasury Secretary, Scott Bessent, there speaking to Bloomberg. The whisper number is rising. It is Jobs Day in the United States of America, 199,000 on the Bloomberg whisper number. The dollar is flat, likewise with equities. Get ready for a potential 1% swing around in these equities. That's the view in the options market. I'll leave you with that view. Bloomberg Surveillance is up ahead.